think we're live. All right, we're going to give it just 1 minute. But if you're out there, if you want to drop hashtag coffee break in the chat, let me know that you're there and that this is actually working. All right, I think we are up and operational. So here we go. And welcome to this week's edition of the Construction CPA's Coffee Cafe. I'm Lisa Raish. I am the Construction CPA. We are dropping the hammer on cash flow problems for contractors with outsourced accounting so you can build things that matter. And this week's topic is understanding retirement savings options and their tax advantages. So retirement savings is one of the many tax saving levers that we tend to use or we tend to pull on when we are doing tax planning for business clients. There are a number of different options. We're going to go through the various options. Number one, it's a great tax savings option. Number two, you're saving for your retirement. So again, more and more of us are living longer lives. So you want to make sure that you do have the funds that you are going to need in order to potentially live 10, 15, 20, 25, 30 years after you retire. We are seeing more and more people living into their 80s and their 90s. So, something to think about for your overall long-term planning, but not just the long-term planning, but also, hey, what are the tax advantages today and maybe down the road when I go to retire? So overall, the ones that people tend to be very familiar with will be your 401k and your IRA, right? So the first will be your traditional 401k and the traditional IRA. So what are they? The traditional 401k is going to be a retirement option that is offered through your employer. The traditional IRA will be something that you would individually make contributions to outside of your employment. And again, the IRA is not dependent upon you having a salary through that a specific employer. It is dependent upon you having earned income, but again, it doesn't necessarily have to be with like that specific employer. So what are the differences? So the traditional 401k, you're typically going to have the ability to contribute a larger sum of money to your 401k than your IRA. So at the time of this recording, the limit for this particular year is $22,500. It's going up next year to $23,000 for a 401k. And then for an IRA, the contribution limits are $6,500 and it's going up to $7,000 next year. And then each one of them also has a catch-up limitation. So if you're over 50 years old, you're allowed to put in an additional amount of money. So if you are over 50 years old, you get to put in an additional $5,000 to a 401k. And then if you are over 50 and you are contributing to an IRA, you can put an additional $1,000 into that IRA. Those are the rules at this moment in time, at the time of this recording. Keep in mind, you'd want to just search and Google the result to literally 401k limits in the year that you're in, IRA limits the year you're in. So again, something that you can easily find in a search on the internet. So with the traditional option, you are getting the tax benefit today. So what does that mean? For whatever dollars that you put in, so let's just say I'm going to max out my 401k this year, and I'm going to max out that 22.5 number. I am reducing my taxable income by the amount that I've contributed to my 401k. When you have an IRA, the IRA contributions that you have are going to be deducted on your actual tax return against your taxable income. So again, keep in mind, traditional really just means it's the deductible one. It's going to reduce your taxable income today. Now, the Roth option is different. The Roth option, whether it be a 401k or IRA, is still going to have the same dollar limits. So your 401k is going to be $22,500 and your IRA is going to be $6,500. The difference between the traditional and the Roth is you're not getting any tax benefit today. You're going to get your tax benefit in retirement. So I make that 22.5 contribution to my 401k this year. I am not reducing my taxable income by that number. What I am going to get is when I retire, when I am of age, so when I'm of at least the 59 and a half years old, which is the age you need to be before, if you take a withdrawal from a retirement, there is no limit. So let's just say anything over 59 and a half, there's no penalty for taking it out too young. With a Roth, I get those funds tax-free to me later on in life. So there are two kind of schools of thought is, do you take the tax benefit today, or are you going to be a high earning individual in your retirement and you're going to want the tax savings in retirement? So it's something that you're going to use. It's an overall tool to determine kind of where you think you're going to fall in your retirement years. So again, the withdrawals are tax-free from a Roth later on in life. The traditional, your contributions right now are going to get you that tax savings. The last option, and one other retirement account that we really haven't talked a lot about, is there are SEPs. So it's a self-employed for self-employed individuals. So with a SEP, you have the ability to contribute up to 25% of your income, or $66,000. So for instance, if you are a Schedule C or you are a partnership, one of the tools we tend to use a lot is the SEP tool for retirement contributions. And again, it's up to 25%, not to exceed. In at this particular time, it's 66,000. Like anything else, you would want to check the limits at this moment in time to confirm exactly what the limits are for you. Another option we don't talk a lot about, but it's something that we've used with some of our clients, is something called the simple IRA. And the simple IRA is just that. It's very simple to set up. And it's something that companies that want to set up an IRA or want to set up a retirement for, or a smaller company wants to set up a retirement for their employees, a simple is very easy to set up. It is, the contribution limits are going to be different. So for instance, at this point, the 401k contribution is $22,500. A simple IRA will only be $15,000, but the employer still has the ability to match. So it's a simpler tool to put in place than a 401k. A 401k requires a level of annual compliance. So typically with that compliance comes additional fees and an investment for the use of that service. So for example, if you are a business and you would like to offer retirement not only for yourself as the owner, but also your employees, a 401k for just a handful of team members could cost you upwards of $5,000 a year in actual compliance fees. Whereas the simple does not have those fees. So again, it's simpler to set up, simpler to maintain. You just don't have the capacity, the limits that you have with the 401k to contribute to. So something to consider. And then we're going to talk a little bit about matching. The matching with that is going to be a little bit different. So what are some of the advantages? So again, with your traditional, they're going to grow tax-free at this point, right? For now, so you can contribute. They say contributing at, the earliest that you can. Like anything else, it begins to compound. So you could be contributing and maxing out your 401k when you're younger. It continues to earn, let's just say, a general 8%. Over the years, you could end up with very easily a fund that has upwards of $1 million in it. Now, that $1 million may sound like a ton of money, but if you're expecting to live 30 or so years, it may not be. So that's where, when you're going to get out of the tax planning space, and this is where you're going to start to have those conversations with your financial planner, not your tax preparer, about kind of what your goals are and what dollars you need in order to retire. That's also a really great opportunity for you, if you are a business owner, to be able to support your team members, offer them that benefit, not only of the 401k, but potentially the option to talk to someone, a financial planner, to in fact help them grow those funds and help them to achieve what they need in retirement. It's a relatively inexpensive way to support your team and provide additional benefits, especially in a more in a marketplace that is becoming more and more competitive in terms of finding team. So we've found that with clients who not only offer the retirement, but offer some level of support from a financial planning standpoint, it's one additional benefit. That's a nice one. And it's another nice item to kind of add to that list of bennies that they're offering to their team members. So again, with your 401k, your IRA, you're going to get those tax bennies today. You're reducing your taxable income today, this year, at whatever the tax rate is. The difference is now when you take the money out of that 401k or that IRA in retirement, it's going to be taxable to you at whatever the tax rates are at that moment in time. That's where the unknown aspect of this comes into play. So that's why sometimes when you're thinking about, do I go with a Roth option where I'm getting the tax savings in retirement, where could I benefit the most from the savings? We don't know what the rates are going to be in 20, 30 years when you retire. We know what they are today. Is there more benefit? Are you still going to be a high earner in retirement? Again, these are all things that it's part of your tax saving plan, but then it really melds into what your overall life and financial plans are, not only at this moment in time, but in your retirement. Again, the Roth, you're going to get those withdrawals. Those are going to be tax-free to you. You're not paying tax to them in retirement. So maybe the tax rates do go up in 20, 30 years. And if they do go up, then now you've kind of buffered yourself against those increased rates, and now you're getting it tax-free, where, you pay the tax. I'm in a 24 bracket. I'm in a 32 bracket. I'm going to pay the tax now because, there's a possibility that in retirement, I'm really going to be in the 35, but the 35 bracket in 20, 30 years might actually be a 45 bracket. So again, it's part of an overall planning process that we don't just look at this year. We look at this year and kind of where the client needs to go. And then we kind of meld those two things together to determine the most beneficial way to move forward from a tax savings perspective. So again, if you are self-employed, you are a small business. So if you're self-employed, if you are that Schedule C, again, we talked about the SEP IRA. There are going to be contribution limits. There are going to be eligibility limits, just like anything else. But again, at this point, it's just you contributing to that plan. Once you have the type of entity where you are employing others and you possibly or may need for kind of competition purposes to offer the retirement, then you want to be looking at something different, right? The SEP won't work. The SEP IRA is for self-employed. You could do a SEP when you have employees. Just keep in mind, if you are paid as an employee of your entity, if the decision is to contribute 15% to the SEP, it is 15% for every single one of the employees. If you're doing it, you can't just do it for you. When you do a SEP, it can't just be for you. It has to be for everyone. Whereas when you do a 401k, that can be the choice of the individual. We've seen it where, the owner is actually the only one in the 401k. None of the team members are in the 401k. So the 401k gives you the opportunity for the employee to choose Whereas with a SEP, there is no choice. You're, as the employer, making the entire contribution. And if the choice is to be, again, 10 or 15%, it has to be across the board, across all of the employees. So something to think about. It is a much more, it costs you as the employer more, but again, if you are in a high competition type of business, it may be something that you want to offer because it makes you more competitive as an employer. And again, be able to attract and then retain the employees that you're looking to attract and actually keep. Again, the simple IRA, like I mentioned, is the simplest form, the easiest to get up and running, making contributions. Again, like anything else, the employees make the choice. If they want to make a contribution, they can. They do not have to. Like anything else, again, it gives you the flexibility to say, do you want this? It might save you some money. Again, what are you looking to do overall from a business perspective that makes sense for you? Now, when you want to maximize your retirement savings. So with many of these options, there's going to be an employer match. So for instance, you're going to have a 401k. Typically, there is going to be a match from the employer. I did see during a period, probably about 20 years ago, where the economy had started to get a little tight and some of the companies were pulling back on the match. They were allowing you to in fact contribute, but they weren't matching. The reality is today you want to have a match. It only increases your benefits package and again, makes you more competitive in the marketplace as an employer. But with the 401k, you have opportunities to kind of adjust what the match is. Typically, a safe harbor match is going to be anywhere from 4 to 5%. And that's going to be kind of across the board. There are going to be some companies that do like to, they increase the match. So if you have a company that does a match, again, for instance, if there is a safe harbor match, the company matches for your 6%, they'll give you 5%. You want to, at the least, contribute to the point where you can capitalize on the match and utilize the entire match. Again, if you're looking for overall tax savings, if you're looking for like longer life planning, you may want to increase that percentage for you as a withholding from your salary, but you want to take advantage of the employer's match. Same thing with a simple. Now, with a simple, the max on a match is going to be 3%. So a simple IRA, the employer match is going to be 3%. The max that you can contribute as an employee is going to be $15,000. Again, the limits aren't as high, but they're easier and quicker to get up and running, operational. There isn't any compliance at year end. So again, 401k, you can contribute more money. There's an investment associated with maintaining that annual compliance. The simple, it's simple, easy, get it up and running, doing your match, withholding for the employee. There really is little to no compliance, but you're not able to contribute as much. So again, you need to weigh which is a greater driver for you. The ability to contribute more dollars or the savings of not having to pay for or engage in annual compliance, which again is a process. It's something they have to take part in. It's something that you have to do. You have something you have to file, something you have to pay for. So those are all things that you want to think about as a business owner. Now, again, you will choose what your contribution limits are going to be as the business. Again, any of your employees are over 50 years old, they have the ability to do a catch-up contribution. Again, with the IRA, it's going to be $1,000 more. With a 401k right now, the contribution, the catch-up over the age of 50 is $5,000. Again, you would want to do the research and just confirm that when, what they are at that moment in time, because those do, like everything else, they do go up pretty regularly, the catch-up doesn't go up as quickly as the actual annual does. but typically it will go up periodically for inflationary purposes and so on. So you do want to make sure that you are, again, contributing to your maximum capacity if you have the ability to do so. Like anything else, we are not investment people, we are tax people, but work with someone to help you with your investments. You want to make sure that you diversify your investments, have them in various different types of tools. Maybe they are in different types of market funds. Maybe they're in stocks or bonds, or maybe some of it is in cash. Again, that's all going to be predicated on how old you are, your risk tolerance, again, how much you're contributing, and so on and so forth. That's a conversation you want to have with a financial planner. That's not something most CPAs have the ability to talk to you about. But, we will tell you, just make sure that you've kind of diversified the money and you're getting the recommendations that you need from the people who are educated in that space to really maximize the dollars and maximize what you're earning and getting out of that in retirement. And again, it's ultimately going to be based on your risk tolerance. Are you younger? If you have 30 years before you retire, you probably have a greater risk tolerance, and therefore will put your money in something that might be a little riskier, because the reality is that it's going to, whatever, again, like anything else, the market cycles up and down. So there'll be downs, but there'll be more ups again. So through your life. So if you are younger, you may have the ability to be more kind of risk intolerant. Whereas if you are getting closer to retirement, you're not as tolerant to the risk. You can't lose almost all of your money now if you are 5 years away from retirement. So again, that's something you want to have conversations with the right investment people just to ensure that you're getting what you need out of your retirement. It's not just, yes, I'm getting the tax savings. Let's get you the tax savings, but then also get you the compounding and the building of that wealth that you need in order to, again, achieve whatever it is that you're looking for at whatever age of retirement. And so there are a lot of different things to think about. So again, we've talked about a lot of different options. We talked about 401ks. We talked about IRAs. There's differences. There's the Roth option. There's a traditional option. Each one of them has different tax benefits. It has the traditional will have tax benefits today. Your Roth options have your tax benefits in retirement. If you're a self-employed individual, you're going to have a different option. You're going to have the opportunity to contribute to something called the SEP. And that's going to be dependent upon your income. So that could be upwards of 25%, or right now would be $66,000 a year. You have different options. If you are a corporation, an S Corp, a C Corp, you can still engage in a SEP, but the way the SEP is handled different than the 401k. The SEP is now everyone contributes at the same rate, and then the employer contributes that. So again, that's tax planning. You're saving taxes on the entity. You're saving, you're now putting away for your retirement. But again, how does that affect your overall planning? It's a great option, but is it the right option for you? And then the last option that we talked about was the simple IRA. And again, like anything else, the name kind of states what it is. It is the simplest one to get up and running and use in your business. So if you are an employee of your business and you have employees and you want to offer a quick way to offer retirement options with a match, a simple is a great way to move forward with that. I know I went through a number of options. There are many things to think about. It's not just tax savings today, it's potentially tax savings in retirement. And then it's also overall investment. How much do you need to get in retirement so that you can retire at the age that you would like and live the way that you would like to live for however long you think that you're going to live? So there are a number of factors to think about. Really, when you're thinking about retirement, it tends to be the quickest and easiest way for us to kind of get started with tax savings with businesses. But it also, you want to bring in your financial planner into that conversation and ensure that whatever your long-term goals are, your long-term goals are being met. So have the conversation not just with your tax planner, but also have the conversation with your financial planner. I hope you found that enjoyable this week. It's always great to see you every week. We look forward to seeing you next Friday. And again, this was the Construction CPA's Coffee Cafe, and we'll see you next week.